let's get rolling. We are so glad to have you guys today. My name is Lisa Lee. I am with ClearEdge Lending here in Eden, Utah. Of course, I have my partner in crime up there in Gig Harbor, Washington, Leah Merritt. Hello, Leah.
Hello.
We are so excited to have you today. This is the second segment of our webinar series that we have started called Lending on the Edge, of course, with Leah and Lisa. And today we are having a full-on open chat about stacked income and stacking all of those sources of income to maximize what your borrowers are able to use to qualify for and to really increase increase their buying power, so they can get into the home of their dreams versus the townhome down the street that they may get stuck in. So anyway, and we are very fortunate today to have a guest, Mr. Adam Wert, our senior underwriter here at ClearEdge Lending. Hi, Adam.
Hello.
He has a wealth of knowledge and information, and obviously his huge background in the industry, but even more important, focused background in subprime, of course, now non-QM, which matters the most to us, right? And he has this way, he gets the common sense approach to underwriting. He has a make sense attitude, and he's not afraid to turn over every stone to make sure that we can maximize what these borrowers can use for income and to qualify with. So it's huge. And please, it's a rare opportunity for us to pull him away. He's slammed today especially. So please take advantage of this rare opportunity and post every single question you have thoughts of in this chat, because it's a rare thing that we can actually chat with him one-on-one. So take advantage of that. Put anything that you have in the chats. We have our wonderful Allie Driscoll from our marketing team running the chats today. Thank you, Allie. And she's going to make sure that all of your questions are answered at the end. I'm talking really fast because this is like a speed dating event with Adam. We only have 30 minutes time. And so I'm going to toss it right over to Leah.
Thank you, Lisa. So let's just go quickly through, because as Lisa said, we are on a timed, we thank you for coming. We know you only have 30 minutes as well. So I'm going to go through and rush a little bit. I'll try to slow down my best. But when we say stacked income, we want you to know that there's several different options for you and your borrowers. It's not just your W-2 and, your fixed income or whatnot borrowers. You can stack income like your wage earner, your fixed income, but you can also place your self-employed borrowers with their bank statements, 1099 and K1, rental income, asset utilization. You may have done some of this in the past or not. That's why we're doing this today. We have what that means is that we'll use your assets like your stocks, your bonds, your mutual funds, annuities, IRA, money market, savings, and CDs. I also wanted to add that I just recently had a loan where we used all lease agreements. So, and all you need with the lease agreements is just that, your current lease agreement for your borrowers or for your borrowers' renters. So.
This is a prime example. So this is actually a scenario. I'm sorry, Leah, to interrupt.
No.
This is an actual scenario that shows a really good example of what we're talking about here. So borrower one, we have the first borrower. He's a self-employed person, IT consultant. So of course they work from home. They don't have any employees, any inventory, any high overhead that they have to carry. And so this guy, obviously, his people pay his business, and then his business pays his personal account, right? So we were able to use 100% of those net deposits coming from his business just with 2 months bank statements. And we are able to, like I say, so we have a zero expense factor for him, and we came up with $56.80 for him in his net income. Borrower two is easy. It's a W-2. We're going to look, we basically calculate the same as Fannie Mae. And depending on, some details, you can use a year and overtime. So, and that averaged, of course. So for the co-borrower, we were able to bring up 79.26. Sorry, I'm getting some dyslexia here. And then the other streams of income are the most important part. And this is where the deals are saved, right? So like with the rental properties and asset utilization, which this is where Adam is going to dive into it for us. But this alone gave us another $16,000 for income, to qualify with. So it's huge. So I'm going to toss this to Adam to give a little bit more detail about these other streams of income.
All right. Thanks for having me on, guys. First of all.
Thank you.
Thank you.
All right. So just to hit some bullet points real quick on these scenarios that both Leah and Lisa have. So just I'm going to point out just common mistakes that I see on loan submissions that can make or break deals. So number one, for example, the scenario that Lisa shows with the separation of personal bank statements and business bank statements. Yes, we can do that with the 2 month bank statements to show that all the expenses are going through there, and any money that's being transferred out of the business into the personal, we can use zero expense. Premise being all the expenses are already accounted for with the business bank statement. So any transfers that are coming from the business account into the personal account is considered pure net profit. That's why we can apply a zero expense factor. Now, one of the most common mistakes I do see with that, and just be wary of that, any other counter deposits, anything that is not coming from the business account, most likely through transfers, cannot be used. It's only designed to be transfers from that business account into the personal bank statement. Sometimes there's some other scenarios. We can look at those with alternative options, possibly an exception. Okay, next on the W-2, just one of the most common mistakes I see is really it comes down to how additional income, such as bonus income, RSU income, overtime, and those kinds of things. So the biggest mistake I see is bonus income being averaged at year to date. And as you guys know, Fannie and Freddie, they require, just like we do, to annualize any bonus paid out in a year, unless we can document they get paid quarterly or monthly bonuses. So a lot of times I'll see year to date use on bonus, they'll qualify it, and then you realize, oh, it's annual, brings it a lot further down, and then your debt ratio now is way out of scope. So be cognizant when you're using additional income, follow the Fannie and Freddie method because we'll abide by the same. Again, some common sense can be applied to it. We can look at possible exceptions. Okay. Next, the rental income part of it, they did want me to speak about the ins and outs of this. So yes, we can use a 15% vacancy factor. We don't need tax returns. We can use a lease agreement, and the requirement is just current lease agreement and most recent month's rent to be proven. Okay, now the big thing with us and what we allow, and I'm sure some other lenders do it, every submission I see, there is no vacancy factor applied. It's just done at 100%. Make sure you're applying a vacancy factor when you're using rental income because it will blow up your debt ratio if you don't do it properly. Now, one of the good things to do with this is instead of hitting it in the schedule of REO that comes as a loss and it will carry over to liabilities, we allow non-owner properties that show a loss to be zeroed out on the schedule of REO and carried over to the other income section where you typically put in Social Security, disability, and that income, but you can put it as a negative, which makes a big difference on debt ratio of page 3 on a negative cash flow versus page 2 as a negative reduction to income. So beware, you can use that and that will save deals. Okay.
I'm so glad you brought that up.
Yeah, me too.
Yeah. So, and that's just the most common mistake I always see on every submission. And it really does make or break loans. You know, we'll try and work things out, but, you know, I just want to focus on those. And then asset utilization, it's pretty straightforward, and we'll get into that a little bit more.
Yeah.
Nice.
So thank you for that. So I was talking to you about what can you say yes to it when you're stacking these income. Now we're going to break it down to what percentages. How do you calculate that? So with that asset utilization that we were talking about, you can use 100% of any checking account, savings account, money market, or this saved one of my deals, and I'm going to kind of go through my success story a little bit later in this. You can use the cash value of a life insurance policy. So I think that's pretty awesome. Also, so 80% annuities, mutual funds, publicly traded stocks, and bonds. 70% would be your IRA accounts, your retirement accounts, 401k and SEPs. So you're looking at what CLTV, primary and second homes, you've got 80% max CLTV. Investment is 65%, and then your cash outs were maxed out at 60. But your reserve, we do not have reserve requirements on these. So we have this calculator that we use. I love using it. I'm kind of a geek. I geek out on this. Adam actually created this. So this is actually a scenario that I had, or not a scenario, this is a loan that I had, and it's actually the scenario, it's the loan success story that I will share at the end of this. So Adam, do you want to kind of just break this down briefly so we can get to that Q&A that I'm so excited about?
So this is a snapshot of what you're looking at for the asset utilization. I'm not going to go too in depth on how the sheet works. It's basically, it's plug and play. You plug in the names, plug in the type of account and the account holders, and it will automatically calculate whose income is whose. That's very important. Most common mistake seen, they just attribute all of the assets to borrower number one, don't account for anything with a co-borrower, and that can happen with a FICO issue when it comes to qualifying. So make sure you're attributing the income correctly to who it is. Now, the AEs will walk you through on how to use this, so I'm not going to spend too much time on this, so I can leave some time for Q&A. But one of the bullet points that I really want to emphasize is when it comes to asset utilization, there's a big distinguishing difference. Now, down at the very bottom of this, you can see that little last snippet says qualified assets. So when you're using asset utilization by itself, you have minimum loan amounts to meet, which is an industry standard for almost any asset utilization program. However, we have a new kind of modification to the program that if you're going to combine W-2 income with, all these other stackable income types that we're focusing on, then all those minimum loan amount requirements are gone. They do not apply if you're combining it with stacked income. So that's nice. Now, secondarily, anybody who's on the asset statements, they have to be on the loan. There are exceptions that are had with that, but they're very rarely approved. So keep in mind, you have a husband and wife on the asset statement, you cannot use it even if it's a joint account unless both of them are on the loan. Any assets that are held as a trust, even though it's our borrower, and you can clearly see we still have to get a copy of the trust. Okay, so you cannot use business funds. You cannot use gift funds, even if they're not being applied towards this and someone's gift funds for just earnest money. You cannot have gift funds at all as a component of the loan when you're using asset utilization. Okay. And then as far as eligible asset types, they're pretty flexible on a lot of them. I mean, there's some obvious caveats like, no 501, charities, nonprofit organizations, those kinds of things. And one of the biggest things to look out for is on your asset statements, a lot of these accounts have what's called a margin loan feature. If it has that, you cannot use that asset because it's being used as collateral for a credit line for borrowers to buy and sell other stocks and bonds based on the assets that are being held as collateral. So keep in mind when you're looking at these to just, make sure that it's the right type of asset. If you have any questions, you can always ask your AE on what's allowable and what's not. Okay.
And also the DTI is 45, correct? If you're using the asset utilization.
So there is a difference. If you're using pure asset utilization, no other income, meaning no rental income, no anything else, your maximum is typically 50%. Now, if you're going to combine income with W-2, retirement income, rental income, then your max allowable debt ratio is 45%. So it's kind of a trade-off by getting rid of the minimum asset requirements and the loan amounts, but lowering the debt ratio. But again, if a loan makes sense, you can always look at a possible debt ratio exception as well.
Right. This is non-QM. I don't know if you guys, some of you were on our last, were able to be on our last webinar or visit. And, there's exceptions to every rule. So just remember that we are always working behind the scenes to make a loan work. So, so to my success story, and then we'll get to Q&A. This was a fun one. So we had two borrowers. They actually lived in the same condo complex and met and dated and then fell in love. And then one of the borrowers moved in with the other and rented out her place. And after a year, they decided it was working for them. So they decided to buy another condo and join their lives together and rent out their condos. They had a really high together debt to income ratio. It was close to 70%. So I asked my loan officer, so do they have any assets? Do they have any retirement? She said, let me ask. I want to say this because a lot of loan officers do the normal thing, right? They get the 1003, they get the income. They don't ask kind of the upfront questions like, do you have any additional assets? Or, collect those things up front so we can put a clean picture together and get these loans approved if we have problems or fallout. We don't always have to use that. Anyways, so we ended up using a ton of stackable income. We used W-2 retirement. They did have assets, which actually ended up saving the deal. One of them had Social Security. Then now we have rental income from both properties. There was 401k, IRA, checking, savings, and mutual funds. I'm not even joking. Like, let me just go back to that one slide right here, the last one. There was so many different types of assets that we used. And then there was a life insurance policy, which at the end came in as a hero and saved the deal. It was like cash value. So we brought that debt to income ratio down to 35%. I do want to mention two things. We use the gross incomes of 85% of the already rented property and then 75% of the departing. So we could use those as additional income as well. Anyways, cool story is they ended up qualifying, and I think they're probably living happily ever after. So it was fun to get that one done. So
that's a good story.
We're to the fun part, the Q&A part. So Adam, do we have Allie? Do we have any questions in the chat? Are you there?
Oh, we do have a couple of questions that came in. Are y'all ready?
I'm ready. Bring
Adam?
it.
All right. Someone asked, if there is stacked income, is it the same pricing as full doc or bank statement?
Okay. As far as stacked income, there's a couple of caveats with that. So number one, stacked income is common in NQM. You can combine bank statement program. You have a co-borrower that also happens to have, W-2 income and all that. So it depends on the program. So like, for example, if you have a W-2 wage earner and a bank statement self-employed borrower, the bank statement one is going to be the pricing because that is the heavier weight on that one. Now, with asset utilization, which we've kind of focused on before, if you're going to use stacked income, no matter what you have, whether it's bank statements, W-2 retirement, it's always going to be priced as asset utilization. If it is a part or a component of the loan, that is always going to be the worst case scenario. And that's typically how pricing is going to be. The worst case scenario as far as documentation, obviously full doc being the best, and asset utilization being probably the most conservative.
It's a great question.
Okay. Well, we have another question. Can you stack income on a non-occupant co-borrower?
Okay, so in that scenario, again, there's two really main components with that. If you're doing a regular bank statement loan, full doc loan, yes, a non-occupant co-borrower can be on the loan. And as far as any of the income, you are allowed to combine and use stacked income. Now, if you're going to use asset utilization as part of the component of qualifying for the loan, you cannot have a non-occupant co-borrower on the loan at all. And that's only when it comes to asset utilization. Anything else outside of that, you can typically use stacked income with a non-occupant co-borrower. But again, asset utilization, you cannot have a non-occupant co-borrower.
Okay.
Well, good to know.
Mm-hmm.
That's a good question.
Another question is it available for primary, second, and investment? If so, can you use assets on DSCR to help rent calculation?
Okay, so there's kind of a couple of questions within that one. So as far as stacked income, yes, you can use stacked income with primary, second home, non-owner properties. They all have their LTV restrictions, depending on credit score, loan amount, So when it comes to DSCR, that is purely lease agreement and market rent. You cannot use any assets to help offset anything with DSCR because it's not an income document type program. It's basically the cash flow of the property. So DSCR, you cannot use assets to help. You can use them as compensating factors such as reserves. But outside of that, assets on a DSCR would have really no contributing factor except for maybe as a comp factor for additional reserves above the minimum requirements.
All right. Somebody asked, do all persons on asset bank accounts need to be on the loan? I feel like you may have mentioned that, but could you touch on it again?
Yeah, so I'll reinforce that. So yes, anyone, when it comes to really any income that you're going to use, now specifically with the asset utilization, most common scenario, husband and wife on the asset statement, husband or wife only on the loan. You cannot use that account, even though technically it's joint, they have 100% access to it, but we require that every person who's on the asset statement, that's an allowable asset statement, must be on the loan. There are some exceptions that can be had. They're very minimally approved, but there are some where you have a husband and wife, assets are in a trust. So technically, the trust does give them authority for either or. spouse to be able to use that. And that's considered on a case-by-case basis. But it's not something that's heavily encouraged either.
The last question I see is there a way to use equity in other properties for those that have a lot of equity but not a lot of cash or assets?
That is actually a really good question and kind of a great point. Unfortunately, I'm going to say no. You can't really look at other equity. However, there is special exceptions, such as, for example, with the asset utilization, right? Typically, the requirements, you want 4 months seasoning. You cannot use cash out proceeds at all when it comes to asset utilization, even though we can use them for reserves on other programs and things like that. However, the one exception to that rule is delayed financing proceeds. Meaning, obviously, delayed financing, typically someone goes and buys the property. It is purchase free and clear. We still have to document the assets that were used to purchase the property to verify that. However, that equity on the subject only when it's a delayed financing alone, you can use delayed financing cash out proceeds for asset utilization if you need to. That is the one exception to that rule. And it does make sense. But as far as equity and other additional properties, no, that's not something that's considered. And I don't think that's something that's really ever used, at least that I'm aware of in other, lenders.
Awesome. Well, that's the last question I saw come in. So.
Well, that was awesome. Thank you so much, Adam. Yeah. Thanks for the questions, you guys.
Oh, I do see one more. Sorry about that. I guess, explain to me why 80% of the lease agreement on current rented property, but only 75% of it departing.
Okay, so, that's really a credit policy as far as the reasoning behind it. I'm sure it's a risk factor. I think it depends. So, number one, when it comes to any other non-owner property, including the subject, you can use 85% of the rents, right? Now, a departing primary, typically what it's used to do is really wash out the liability, meaning when you have a departing primary, 75% is what's allowable, but you also cannot have positive rental income on a departing primary residence. There can be exceptions to that, like if they have investor experience. So they don't really distinguish that in the guidelines. So right now it is a 25% vacancy factor with a departing primary with no positive rental income. But there are cases where you can do an exception for it. So again, it's not a hard no, it's a guide as a guideline. And you can always possibly ask for an exception, which is a case-by-case scenario because every loan is different. Some are very strong, some make sense, and some they just don't have the history of it. So it's a matter of just risk when someone has never been an actual, property investment owner. So they kind of limit the risk by not having the experience. Whereas someone who maybe has 4 or 5 other investment properties, that could be looked at as a possible exception. So again, it's just a guide, but that's just kind of where it is on the guidelines. But again, if it makes sense, we can look at it in a possible exception if needed.
This is non-QM.
Yeah.
Sessions.
Awesome. Well, that was the last question.
Awesome.
Oh, there's got to be some more questions, I'm sure.
Come on, keep throwing them in if you
can't
have
be
them.
shy.
We'll move on, but if you have I'm sorry, Leah, we have another upcoming webinar next month. We will be on our 3rd webinar in this series, and it's going to be a deep dive on bank statement loans. That's going to be on September 11th. We have a couple guests joining us, which you will see on our posts and on LinkedIn and everything else. So we'll get that supplied to you. If you ever miss an episode of one of these webinars, you can always find us under ClearEdge Lending at YouTube. Of course, Allie is great at posting these on the recorded series. I think you actually receive that, don't you, Allie? Do they receive it automatically, the recording?
I will have to double check, but they possibly.
So we will also provide that. Leah and I will provide that on LinkedIn and other sources of social media as well. So we want to thank you guys. It's amazing to have you with us. It's really fun to have these open communications, especially with people like Adam. Thank you so much, Adam, for joining us today. It's huge. Huge.
Yeah, thanks for having me on. I don't mind coming back, for later, episodes if you guys will have me. But this has been fun, and I think it's a great opportunity for other people to be able to pose questions on things that aren't always addressed. There's always scenarios that can come up with that'll kind of be different than what's in the guidelines.
Well, yeah,
Amen.
I learn something new every day. So, hey, call us for any, any scenarios or questions that you have outside of this. Also, we love to do that one-on-one training. So reach out to myself or Lisa anytime via text, email, phone call. We are here to help you. Thank you so much for joining us. We appreciate the support, and I think we're on time.
Yeah,
So
we get 4
get back
minutes
to
back
work.
of your day, so that's awesome. Adam, you
All
go
right,
back to
now I
work.
got conditions to clear and loans to
Yes, you
approve.
do.
That's what we like, so you can go back to work.
All right. Well, hey,
Bye.
thanks for having me
Thanks,
on.
you
Take care,
guys.
guys.
Have a good
All right.
day today.
Thanks.
All
Take
right.
care. Bye,
Bye.
guys.